If you are an Nvidia investor, you know you have found the needle in the haystack instead of buying the haystack. You have found the gem hiding among hundreds of tech stocks that began their uncertain journey in the first decade of the 21st century. Your money has grown by 276,466% within the last 25 years. At that rate, your $1,000 investment has become $2,764,660 today. You have created generational wealth, and you should be proud of yourself. Indeed, Nvidia has grown from under 50 cents in January 1999 to $1,255 in June 2024. It has grown 3,225% in the last 5 years. Compared to that, the S&P 500 rose by only 85%, Meta or Facebook rose by 184%, and Amazon and Broadcom grew by 105% and 409%, respectively. Only in the last year, Nvidia stock rose from $374 to $1,209, which is over a 222% growth. It has a market cap of $3 trillion and has overtaken Apple as the second most valuable company on Earth. If you did not invest in Nvidia in the early days of its growth, but took a position in it only at the beginning of 2024, your investment has still grown by an enviable 147% so far. But this video is about what to do now and how to protect your gains in Nvidia before the stock collapses like many other successful stocks did in the past. What can you do to get a part of Nvidia's future growth without losing the growth you have already achieved? You don't want to see your gains disappear within a few days or weeks. You don't want the stock to bleed and lose ground to fall more, going down to $200 per share within the next year or two. Even great stocks fall and fall tremendously. That is exactly what happened after the internet boom of 2000, during the financial crash of 2008, and following the tech boom of 2021. A company does not need a solid reason to lose its value and share price. Meta, Apple, Amazon, Microsoft, and Netflix fell at some point from their heights. Some lost 50% or more of their value, and some needed years to reclaim their peaks. Energy giants Occidental, Chevron, ExxonMobil, and ConocoPhillips gave up years of gains in a week during COVID-19. Therefore, a collapse in the Nvidia stock should not be underestimated. Now that you have seen the recent stock split of Nvidia, you should be worried about your position in it. This chart shows you all the 5 stock splits the stock has gone through up to 2021. As you can imagine, Nvidia experienced a decline 4 times out of 5 in the 24 months following the split. In those 2 years, the stock fell as much as 50% at least 3 times. If Nvidia stock falls 50% from its current price, it will fall to $600 per share. That will cause a huge dent in your portfolio. However, at least twice during 2001 and 2007, the stock declined by over 70% within the first 12 months following stock splits. Sometimes a stock grows and grows only to be seriously fatigued. Nvidia enjoyed the AI boom of recent years like no other company, but every boom busts at some point, making space for a new boom based on new materials, new technology, or innovative ideas. Any stock, including Nvidia, is just only one fiscal year, one bad publicity, one unwanted interview, or one class action away from declining fast. As an investor, you have reasons to be worried. As I said above, if you want to lock in your gains and still want more from Nvidia's future growth, your best bet is getting a collar. Collar is an options strategy that is easy to implement. It is cheap and will work as an insurance for your investment. Let me explain in detail. A collar is a defensive options strategy. It has 3 conditions. Number 1, you keep holding your stock. You don't sell them now, even though the market is volatile. You hold them because you believe the stock will make new highs and grow even more. Number 2, you buy an out-of-the-money put option. A put option is considered out of the money when a stock's current market price is higher than the option's strike price. For example, a stock is selling at $100 per share. To implement the collar strategy, you buy a put option at the $90 strike price. Number 3. You sell an out-of-the-money call option. A call option is considered out of the money when a stock's current market price is lower than the strike price of the call. For example, a stock is selling at $100 per share. To implement the collar strategy, you sell a call option at the $110 strike price. Let us see what this strategy looks like in the case of Nvidia. This is Nvidia's daily chart. Between March 2024 and May 2024, the stock fell from $970 to $755. That is a decline of about 22%. Outside this sharp decline on Friday, April 19, 2024, when the stock lost over $80 per share, it mostly remained within a daily range of $60 per share. That means, on a normal day, the stock may fall up to $60 per share and then rise again about that amount the following day. If you have already reached your financial goal with this stock, you may buy a conservative put option $60 below Nvidia's current price of $1,210. Thus, your strike price will be $1,150. It means that if Nvidia stock starts falling, your shares will be sold at $1,150. But if it continues to grow further, you will enjoy the extra equity, and your option will expire valueless at the expiration date. You can buy another out-of-the-money put option to lock in the new profit at a higher strike price. If Nvidia rises to $1,400, your new strike price may be $1,340. You can continue doing the same until the stock hits your strike price and your shares are sold. Then, why should you also sell an out-of-the-money call option? Buying the out-of-the-money put option will require you to pay a premium. You pay the premium to the seller of the option through your brokerage firm. The seller will be under the obligation of buying your shares at $1,150 per share, even if the market price of that share is well below that strike price. That means the seller is taking a significant risk to buy your shares. The premium goes to them, so they also win something from this option agreement. However, by selling an out-of-the-money call option above the stock's current market price, you give the buyer of that option to buy the shares of Nvidia if the price of Nvidia rises to or above the strike price by the expiration date. In that process, you earn a premium from the buyer of the call option. You use that premium to pay for the out-of-the-money sell option. Selling the call option and buying the put option happens simultaneously within the collar option strategy. You don't have to calculate how much money was coming in and how much of it was going out. The options brokerage software will take care of the transaction as soon as you select the strike prices and click the button to execute the strategy. If you do not understand options, you can call your bank or broker to implement the strategy for you. They may charge you a fee of $45 to $50 for telephone trading, but that is okay as long as the trade is set up flawlessly and your profits are locked in. You must remember that you will receive a smaller premium if you go very far away from the current price of the stock when you sell a call option. If Nvidia trades $1,200 per share today, and you imagine it rising to $1,300 within the next 6 months, your premium will be higher than if you choose $1,400 as your strike price for the same expiration date of your call option. That means you will pay more out of your pocket to buy the put option. This strategy can well be implemented after the stock split. Find a strike price for your put option below the average volatility range of Nvidia and above it for your call option. The share price is constantly changing, so you have to decide your strike price the day you buy or sell your options. Even though you pay some money to buy your put option, it is money well spent. Your shares will be sold at a specific price, even if the share prices fall across the industry. Thank you very much for watching this video. Please subscribe to my channel and like this video to help YouTube distribute it to more Nvidia stock investors like you. See you in the next video.